Hi everyone, and welcome for another video on how to invest for financial independence. So today I'm going to share the main evidence that exists that supports index investing, which is basically academic research and studies that basically show that index investing is an extremely efficient way of investing. And it actually beats most active and professional fund managers. So for that, I have prepared a few slides. So if you're listening to the audio version, you'll find the slides in the description. Yeah, so I'm gonna share my screen for those of you who are looking at the video version. Right, so you should be seeing the slides. Apologies if it doesn't show, because I'm not always sure if it's actually going to show. But yeah, so evidence-based investing, how to invest, how to beat most active and professional fund managers with index ETFs. Like the first piece of evidence that I want to bring to your attention is a piece of research by Dalbar, which shows that investors are actually their worst enemy. And so the evidence is pretty simple. They've done a study looking at investors' results over 20 years, and they've been doing this since 1984, right? So every year they publish an update. They take the last 20 years, and they develop those results. And so they look at what the market has done, right? So in this case, the equity market, what's the average return over the past 20 years? And so over the past 20 years, so from 2000 to 2020, the average returns for equity markets is 8%. And that is including two major crashes in 2002 and then 2007, 2008. But they also track the performance of actual investors. And on average, investors who are in the equity market have only managed to get a performance of 4.2%. So there's a massive gap of almost 4% in terms of performance. And that is due to the investor, because the market is doing what the market is doing, right? So if we were to get the returns in the market, we would all get 8% and that's it. But on average, investors only get about 4%. So the question is, how come there's this almost 4% difference, right, between what the equity markets are doing and what average investors are doing? And now this is the results for the last 20 years, but the study shows that this was the case for every year that this study has taken place. So that's for like close to 35 years anyway. And on top of that, this is not discounting for inflation. So most investors on average are getting 4.2%, but there's about 2% of actual inflation. So the real returns of investors are 2.2% instead of 6%. So they get a third of the actual returns. And that's a disaster, obviously. But so, yeah, the Dalbar study is the quantitative analysis of investor behavior. So they look at investors' behavior and how that impacts their performance. And their findings are very simple. There are two key reasons why why the average investors don't get the returns of the market, but get 4% less. And the first reason is fees. So this is everything from transaction fees to taxes to management fees to middleman fees, all the fees related to investing, and that basically slow down your growth, right? Because for every percent that you're paying fees, that's a percent less that is growing. And we see if, there are ways to invest and pay very high fees. The next one is emotion and speculative behavior. So that is the tendency that most investors have to think they can predict the market and to try to predict what's going to happen based on either technical analysis or fundamental analysis or whatever other strategy they might use, stock picking, asset, strategic asset allocation, whatever technique that is being used, that is basically trying to be smart, right? And trying to be smart seems to work against investors because we are driven by our emotions and we try to speculate as to what's going to happen in the market And it's extremely difficult to be right often enough that you can beat the market with those strategies. And so these are the two reasons that this study found, and that leads to this 4% gap in terms of market returns, in terms of performance. And the solution is actually pretty simple. And you know what it is, obviously, is low-cost index funds buy and hold the entire market. And why is that? Well, it's pretty straightforward. Low-cost index funds are basically a way of minimizing fees and maximizing diversification, and basically also removing emotions and speculations from the equation, because you buy, you hold, you don't do anything depending on what the market is doing. You simply stick to your plan, which is contribute on a regular basis, either monthly or quarterly or whatever it is, rebalance based on specific criteria that you've set in advance, and you just stick to that plan no matter what the market does. You're not trying to forecast anything. You simply stick to your plan, and you buy and hold equities and bonds, whatever your portfolio is made out of, and you're not trying to be smarter, and you minimize fees. So that seems like a pretty simple solution, right? So the two key problems are fees and speculative behaviors, trying to time the market. Well, let's just remove that from the equation. And so that, no, that seems to be the way to beat the market. Now let's see if there's more evidence that supports this approach. And luckily there is. So that bar is one excellent research. There are many more studies that show this, but the other one that I find that's really interesting is the SPIVA Scorecard, which is also something that's published on a regular basis, I believe every 6 months, maybe even quarterly, and has been, as it's been going on for a long time. And so in this study, it's again a study that looks at all funds and the performance against their benchmark, right? So it's not the average of all investors, but it's the average of all professional managers and how they compare to their own benchmark. And they do this, they look at different periods of time, right? So over the last year, how have those professional managers done compared to the benchmark that's supposed to be tracking, right? Or to try to beat. And so over 1 year, there's only 30% of active managers or professional fund managers that actually beat their own benchmark. And so there's 70% of them that fail, right? And as this time period increases, the number and the percentage of professional and active fund managers that fail to beat their own benchmark increases. So let's say for 10 years, we're close to 10% only that actually succeed at doing better than their own benchmark. After 15 years, still around 10%. After 25 years, we're around 5%. After 50 years, it's just 1%, right? So for us index investors and for us buy and hold investors who are looking to build financial freedom and security for the long term, 50 years is actually not that far off from what we're trying to do, right? So for most of us, we want our money to be there all the way to retirement, and then all the way through retirement, until we are well into our 80s and 90s and maybe hundreds. So we want our money to be invested for 30, 40, 50 years easily. And, maybe we want to pass this on to our descendants. So we are looking at very long-term investment. And so 50 years, it's a pretty good long-term perspective. And there's 99% chances you will not even get the market returns if you pick an active manager or a professional fund manager, right? There's only 1% of them that will beat the market over that period of time, but you don't know which one these are. And so I'd rather be on the safe side and be better than 99%, or better than the vast majority of professional investors, and simply stick to index funds, right? So that's the solution. We stick to low-cost index funds. We buy and hold the entire market. We're not trying to time the market or be smart or analyze and think that we know something better. And that strategy simply outperforms the vast majority of professional fund managers over the long term, which is what we want. So these are two of the key studies that I have found that are done on a regular basis. And so you can go and check the results from previous years and see how that evolves. But basically year after year, the same results keep coming, right? There are some changes, but on average, this is what we see. Active management, so trying to be smarter than the market, just doesn't work consistently. And the longer time period, the worse the results. Now let's look at a more practical example. In this case, I took numbers from the Belgian population, and I looked at how much Belgians are actually saving every month. And that number is around 270 euros or something like this. And I've basically assumed that someone starts at 25, saving that amount regularly every month and putting it aside. And the total contributions over 40 years will be just under 200,000 euros. Now, if that person puts that money in a saving account, what happens? This graph here does not account for inflation. This is simply, euro for euro, what happens to the money if you put in a savings account. Now, this could change, obviously. It's based on today's savings accounts rates, which are 0.1%. But basically, your money doesn't grow at 0.1%. And this is what's shown in this graph. If you put your money on a savings account, nothing happens. Actually, something bad happens. Your assets are losing value to inflation. We will see this in a later slide. And I will explain inflation. Now, if you are an average investor, as we've seen earlier, that actually performs, has a 4% gap compared to the market. And so it gets a return of around 4%. This is what you would get. Now, I made some assumptions that are actually conservative for this purpose of this exercise. And so this is actually more conservative than what I could have done if I wanted to prove my point. I've only used a 3.5% gap there. Anyway, just to be on the conservative side and not to take the extreme just to prove my point. This is where I'm going to. Right. So this is what an average investor would get based on the Delba study, right? And so instead of being around 200,000, we are close to 400. So that's practically doubling your investment. So investing is important, right? Even if you're not, even if you are simply trusting someone else to do it, as long as it's not insanely stupid and insanely high fees, it's still better than keeping your money in a savings account. As long as you invest for the long term, which means that you're dedicated to go through the ups and downs, right? Because if you sell at the wrong time and you pull out, then obviously it can be very negative. Now, if you invest in index funds, but somehow, or say you invest with the Belgian bank and somehow the returns of that specific fund that you picked or that portfolio matches the market. So matches what index funds would do, right? So this is assuming that an actively managed fund would do as well as an index fund, but you're still paying the fees that you would pay in most banks. So in this case, I took one of the biggest banks in Belgium and I took their most famous funds and I looked at the fees, right? Entry fees 3%, management fees 1.30 something, 1.24, and then there's an extra fee of extra management of 1%. So it's 2.24% of fees. It's insane. And a 3% entry fee. And on top of that, you probably pay higher taxes than if you were going with index ETFs because they can't promote certain ETFs that we can actually invest in that are more efficient. But so if you invest with the Belgian bank, your money will increase by 2.5 times over this 40-year period, which is not bad, right? Which is not bad. But then if you were to invest with index funds, and again, I repeat, I have used conservative estimates here. So we're not getting 8% a year. We're actually using 7%, assuming that we have a pretty big component of bonds in there or some sort of fixed income. And I'm assuming 0.5% fee. No, wait, I'm assuming 0.3% ongoing costs and a few other fees in there, right? And so this is what we get with index investing. So the blue line is what you could get, right? And that's times 4.6, almost 5 times the amount that you saved. That's what you would get at 65, right? And that's by saving just, between 200 and 300 euros a month, right? You can reach, 800,000 by the time you're 65. If you save a little bit more, you can easily become a millionaire, right? But the key here is to understand that there's a massive difference between investing, with the best that there is in the banking system and then investing outside of that using index fund in a very simple and effective way, right? So let's look at that difference. The bank is basically taking half of your profits, right? So you went from here to here with the bank, but if you had not worked with the bank, you would be, you would have double the profit. So the bank, for the service that they're providing, they're taking half of your profit from your hard-earned savings, and all of the time you've put into actually earning that money and then saving some of that and investing it. They take half of that, right? That's what drives me crazy, and that's why I believe this is so important. That's why I want everybody to know about this, because anyone that is watching this, if you're investing in any other way than index funds, let's say in the stock market, I'm not going to go into other type of investments, and you're not using index ETFs in a simple and effective way, then you're losing so much money. You're losing, in this case, if you never learn about this stuff and you never change your strategy, then you're giving up at least half of your profit to the system, to the banks, to the fund managers that are often overpaid for, as we've seen, not even delivering on what they're supposed to do, right? Because we've seen that over the long term, they cannot beat their own benchmark. They cannot beat the market. So why try to beat the market? Just buy the market. That's what index funds do, right? So anyway, half of your profits are gone over 4 years. And if you're the average investor, so that was if you're lucky, right? And if you just end up picking, one of the very best funds in one of the, most famous Belgian banks, which we don't know if it's actually going to happen. But most investors will actually lose 70% of the profits, right? Because average investors, we've seen the data, is very clear, are massively underperforming the market. So 70% of your profits gone to, emotions and speculative behavior and fees. That's basically what you're paying if you don't learn how to do this in a very simple and effective way, right? So index investing is super powerful. Like, it saves you hundreds of thousands of euros. That is the value of this simple knowledge. And that is why it's worth investing a bit of time and maybe a bit of money. I don't know. Buy books, get an online course, find a coach or something. I don't know. But the value of that knowledge, right, and the value of putting it into action in the right way is insane compared to everything else you're doing in your life. You spend, years and years saving, right, to give up 70% of it because you didn't take the time to learn how this stuff works, right? That's madness. That's madness. And I was doing that not too long ago. That's how I started, right? I was asking, okay, how do I save for my pension? I didn't have access to the Belgian pension system. I was abroad, and everyone was pointing me back to the savings plan, right? That are sold by financial advisors and banks. Even my HR was telling me that's what everybody does. And that's even worse than this stuff. Like, I was giving up almost all of my profit. But that's what everybody was telling me to do, right? So if you're in this position and you've started investing with the bank or financial advisor, or if you have a savings plan, I understand, like, it's not your fault. The system is not made to support investors. The system is made to make money for themselves, right? But that's something you need to realize, is they're not there to help you. They're there to convince you to put the money with them so that they can make money on your money and take most of your profit over the long term. So, like, it's not your fault, right? As the system is built against us. But if you're watching this, then you can do something, right? You know how important it is to actually try to dig into this stuff, because it's life-changing. And you probably know people who are doing that as well, right? And so I suggest you just send them this video. Maybe it will help them. It will help open their eyes, right, on something so simple yet so powerful that can completely transform their lives. Now, as I said earlier, these are all numbers that do not account for inflation. If you put inflation into the mix, it gets even worse. So the next graph is exactly the same data, but accounting for inflation, which means, for those of you who don't know what inflation is basically the fact that as time passes, your cash loses value and can buy less of the same stuff. So say you need 2,000 euros to live today comfortably. In 10 years, that would be 2,000 euros times 2% compounded over 10 years, which I don't know exactly what it would be, But it could be 2,500 to 3,000 or something like that, right? But to get the same level of comfort, to buy the exact same things, you would need more money in the future. And so that means that as you save, even if you don't invest, if you keep it on a savings account, for example, or simply as cash on the current account, that money loses value. And so that's what this orange line shows here, right? The savings account is actually losing value compared to the contribution. So you've contributed close to 200,000. Well, you just have over 100,000 if you don't invest it. So fear of the market hurts even more than investing in a poor way. As long as you keep investing and you can ride the ups and downs, right? But not investing is the number one mistake of people who save money, because your money loses value, and so you have to protect yourself against that. This is a major risk that everyone has. I had that for a long time. I had no idea, right? My money was on my current account. I had no idea how to invest. I didn't even think about it. Well, I was losing. And so that's the very first thing we need to get out of, is like we need to learn that not investing is a major mistake. And then investing in a poor way is a very bad mistake. And investing well is life-changing. So, and it's not difficult. It's super easy. It's something you can learn in a few weeks or a few months. It took me years because I was all on my own back then, but now today there's so many more resources, right? So with inflation, the numbers get worse, right? So instead of getting close to 800,000, we get to 500,000, which is basically saying that in today's money, the 800,000 would only be able to buy you as much as 500,000 would, right? So we basically lose the value over time, which means that in this case, it shows what you would be able to buy in today's euros. I don't know if that's clear, but I hope it makes sense. If you're not familiar with inflation, just Google it quickly. Hopefully you can understand what I mean. Now, the gaps are even bigger in this case, right? Because instead of losing 50% of our profit to Belgian banks, we lose 60% of our profits. So our profits are lower, but Belgian banks are also doing far worse because of inflation, right? They have to step up their game to be able to beat inflation even more. So 60% of profits are gone. And for the average investor, 80%. So instead of getting the nice, in this case, it almost, it's times this 2.5, well, you just get a little bit extra compared to what you've saved. And 80% of the money goes to speculation, emotions, and fees, right? And as I said, this is all using fairly conservative estimates, right? And I've included the costs, I've included taxes, I've included all sorts of things in there. It's fairly conservative. Obviously, it does not include the volatility of the market, right? But it does take, it simply says, well, we'll take the average over that period of time and we'll apply it uniformly throughout. The truth is it will go up and down, up and down, up and down, right? So it's difficult to ride the ups and downs, but it's important to ride the ups and downs in the right way and using index funds because it leads to far more benefits, right? And it's not about getting richer. Like I keep saying, I'm not doing this because I want to help rich people get richer. No, I want people to understand that they can build themselves financial security and financial freedom so that they can focus on things that matter more than money. And they can use money as a tool to live a better life rather than just stress about money because they don't have enough. If you don't have enough, then you learn how to invest well, then you will not have that problem anymore. And you can actually do something good with your life, be happy and help others, right? So that's the goal. I'm not here to say, hey, we should all do this so that we can get super rich. Maybe some of you, that's what drives you, but really the goal is that will free you to actually do good things. Anyway, I'm doing a much longer than 10-minute video today because I'm really excited about this stuff and it's super important. And I hope it's working and that you can see the slides. Anyway, now how much can it change your life, right? So let's imagine we took a random line here that to be able to live well, a certain person needs to get to 240,000 euros, right? Let's say that person has other income streams and that with these 240,000 euros, very comfortable life for whatever, the next 30, 50, 60 years, whatever it is. If that person was investing in a normal way, right, as the average investor, then it would take all the way to 65-year-old to actually get to that number. If that person is using index ETFs in the very simple buggerheads approach, right? Low costs, maximum diversification, keep it simple, no market timing, buy and hold, then the person would reach the same amount at 52, right? So that's a 13-year difference. So this knowledge basically translates into saving 13 years of having to work and save and invest, right? How much do you value, 1 year of your life? Let's say, how much do you value 1 day of your life? How much do you value a week of your life? How much do you value a year? How much do you value 10 years? Like, how much is that worth to you? Like, to me, it's worth a lot. And it's time that, that we lose because we don't know a few simple things. Now, this should be taught to everyone at school, at uni. It should be in it should be mandatory everywhere, right? Because it's about living a good life. It's about being able to use the tools that are at our disposal. Money, which is one of the biggest tools. It's one of the ways we transfer energy from one and the other, value. And if we knew about these basic things, then we could all live much better lives, right? Because we would have much less stress, with free time, we would free our energy. We could actually focus on things that matter. So in this case, 13 years. And this is just one example, right? Using the average savings of a regular Belgian person. And that average regular Belgian person is also able to learn how to invest in the index funds, because it's really simple. All you need is maybe, just to be able to sit down and read a book or watch a few videos and learn and just take action. And if it's difficult, then find someone to guide you. Find a community like Financial Independence Belgium, but like any others, go to the Boggerheads, ask questions, make sure you understand all of this, because it can be worth like a fourth of your career, right? This is a 40-year period, and this 13 years can be saved. So it's simple. You just have to do it. The resources are there. There are books, there are courses, there are videos, there are people that can help you. There are people who are your friends. Like, if you know someone who's investing, well, just ask that person to coach you through the process, right? Because it's going to change your life. It's super important to actually do this. It's simple knowledge. Everyone can do this, and it can buy you decades of time. I mean, it bought me decades of time, and I wish it will buy you decades of time, because it completely transformed my life. Like, instead of being in this rat race all the way to 65, 67, I'm in a completely different space, right? A completely different life. It's just like, it's so hard to imagine when you don't know that this is possible. But I'm right in there, and I wish that to you. I want you to benefit from this, because it's simple and it's beautiful. And I've spoken about the benefits of, financial independence and what changed in my life, and the benefits of index investing before. And I'll keep speaking about it because it's super important. But we have a massive problem, is that most people don't know about this. So I'm glad you're here. I'm glad you're watching this. If you're here still, because this is a very long video, then, thanks for being here. And I hope you take action. I hope you make this happen, because it's going to change your life. And then if you need any help, let me know. I'm happy to help. That's what I'm here for. That's why I'm recording this. And if you have any questions, let me know in the comments. You message me directly, no problem. My email address, there's a contact form on the website. Just let me know what you need, and I'll help you out. Yeah. Right. That's all for today. It is the longest video I've ever done. I was supposed to make those live videos short and simple, because they require a little preparation, but today I went big, and it's such an important topic that I basically decided not to think too much about time. Right. I hope this was helpful. Take care, everyone. I'm just going to close this so I can say goodbye. Yeah. Take care, everyone. Please learn about this. Take action. Download my beginner's guide to index investing, because I basically lay out all the steps that you need to take to get there. Connect with people who are doing this. Learn, right? Just get the book, get that video, connect with the people who are doing it. Learn and do it, and like build this freedom that you deserve. And disconnect from this system that basically pushes us to work until it's too late. I want you to have more options. So this is one way of building so many options and opportunities in your life. I'm counting on you to take those opportunities. So yeah, good luck, and let me know if you need help. Cheers.